Hello, dear students. I'm Miss Ekavya, Assistant Professor, Department of BCom IT from PPG College of Arts and Science, Coimbatore. Today, in this video, we are going to see the first part of direct tax titled on Assessment of Individual. So, now let us see the meaning of direct tax. So, direct tax is paid directly to the government by individuals or organizations, and the burden of tax cannot be shifted to another person. And it is levied on income, profit, or wealth. And the common examples include income tax and corporate tax. And it is based on the ability to pay principle, which means the higher tax is paid uh, by the higher income holders. And it also helps in reducing income inequality in society, and it provides major revenue to the government. And the direct tax is progressive in nature, and it also ensures fairness and equity in taxation, and it requires proper record keeping and filing of returns. The direct tax may involve complex procedures and compliance, and it also plays an important role in economic development and welfare programs. The next slide is about the objectives of direct tax. So, the direct tax, the first thing is to generate revenue for the government. The primary objective of direct tax is to raise funds for the government. These funds are used for public expenditure such as infrastructure, education and healthcare, and defense and administration. The second objective is to ensure fair distribution of wealth, which means direct taxes follow the principal ability to pay. People with higher income pay more tax, higher while those with lower income pay less, and this reduces the gap between rich and poor. It also helps in achieving social justice and economic equality. The third objective is to promote economic stability. The direct tax helps the government control economic fluctuation, and during inflation or boom, government may increase taxes to reduce excess money in the economy. During recession, government may reduce taxes to encourage spending and investment. This helps to maintain a stable economic environment. The last objective is to control inflation and consumption. By increasing taxes, the government can reduce disposable income of people, and this leads to lower demand for goods and services, helping control inflations. It also discourages excess or luxury consumption, and it helps in maintaining price stability in the economy. Now let us see the residential status of an individual. Residential status determines tax liability of an individual. It decides how much income of a person is taxable in India, how much a person may earn income in India and abroad, but tax depends on their residential category. And it is based on the stay in India, not on citizenship or nationality. And the residential status depends only on number of days a person stays in India, and it does not depend on Indian citizen. And the next thing is it is calculated for each previous year, which is determined separately for every financial year. And the person status may change from year to year depending on the state. Now, let us see a flowchart on residential status of an individual. First, we check how many days the person stayed in India, which means the person has to stay in India for 182 days or more in a year, or has to stay 60 days or more in that year and 365 days or more in last 4 years. And if yes, person is resident in India. And if no, person is a non-resident. Now, in step 2, if not satisfied, they will be determined as non-resident, which in shortly called as NR. And the person is treated as non-resident in India. So the next thing is about taxability. Only income earned in India is taxable, and the foreign income is not taxable. Step 3, if satisfied, he is resident in India. He is determined as resident in India. Now we further classify the resident into two types using additional conditions, which is to determine whether the resident is ordinary or not. So the first is resident in India for at least 2 years out of 10 immediately previous years and stayed in India for 730 days in 7 immediately preceding years. If both conditions are satisfied, it is called as resident. He is called as resident and ordinary resident, which is shortly called ROR. If these conditions are not satisfied, he is a resident but not ordinary resident. Now let us see about income under salary. So on income under salary, we are going to see the meaning of salary and allowances which are taxable and exempted and the deductions from salary. So what do you mean by salary? Salary is the remuneration received by an employee from an employer. It is given in return for services rendered. It may be paid in cash or it includes basic salary, bonus, commission, allowances, and perquisites, taxables under the head income from salary. Now let us see what is allowances. Allowances are fixed amounts paid regularly along with salary. So the taxable allowances are dearness allowance, city compensatory allowances, and overtime allowance. So dearness allowance means an allowance is paid to employees to compensate for rising cost of living, commonly given to government employees and pensioners and also in some private sectors. Dearness allowance is calculated as a percentage of basic salary. And the second thing is city compensatory allowances, which is shortly called as CCA. It is an allowance given to employees working in big cities. It is paid to compensate for higher cost of living in urban areas and is mainly provided in metro or high cost cities like Mumbai, Delhi, Chennai, etc. And the next thing is about overtime allowances, which is shortly called as OTA. It is an extra payment given to the employee for working beyond normal working hours. It is usually paid when employees work extra hours, weekends, or holidays. Its purpose is to compensate employees for additional work time and to encourage employees to work beyond regular hours when required. Now let us see partly or fully exempt allowances. The first thing is house rent allowances, which is shortly called HRA. It is an allowance given by employer to employees to meet rental expenses. It is provided when the employee is living in a rented house and it forms part of salary income. And its purpose is to help employees pay house rent and to reduce financial burden of accommodation. Second, partly or fully exempt allowances, transport allowances. It is an allowance given to employees to meet the cost of traveling between home and workplace. It is paid to cover daily commuting expenses and to help employees manage travel costs and to reduce the burden of daily commuting employees. And the last thing is about medical allowance as per the rules. It is amount paid by the employer to meet medical expenses of the employees and it is usually given as a fixed amount along with salary. The following are the deductions from salary. Deductions are amounts reduced from salary to arrive at taxable income. And the common deductions are standard deduction, professional tax, entertainment allowances. The standard deduction is a fixed amount deducted from salary income and is allowed to all salaried employees and pensioners. The professional tax is a tax levied by state governments in India. It is charged on income earned from salary or profession. And entertainment allowances for government employees. Thank you.